Hi there, Dan Kurz, VK Analytics. It's January 26th, 2016. Thanks a lot for tuning in. We'd like to draw to your attention that we have just published a new post on our website, dkanalytics.com, dkanalytics.com. It's about investing in debt-induced deflation and what role gold, and by extension silver, can play in such a scenario where debt, mountains of debt, which have gotten progressively bigger thanks to central banks allowing, in essence, governments to live beyond their means and society as a whole for decades, and increasingly so in the last 5 to 8 years since, well, say in the last 8 years since the 08-09 market meltdown and crisis in confidence, liquidity crisis, solvency crisis. Well, as you probably know, we've doubled down on all the mistakes we made then. We have higher liquidity risks, greater counterparty risks, larger debt to GDP around the world, more trampling of property rights, less respect for the rule of law. In other words, we're going in totally the wrong direction, and we have set the fuse for a massive revaluation, a reset of globally elevated stock and bond prices, despite the recent weakness, pronounced weakness in stock markets around the world. We still are massively overvalued on balance, especially given the fact that they haven't extinguished a business cycle. We've been in a very weak and artificially induced upswing globally for the last 6-7 years. We're long in the tooth, and we do not have organic growth. In other words, the earnings growth we have is financially engineer based, which doesn't surprise you, does it? Given the fact that we're, in essence, engineering everything financially instead of with productivity. Well, silver and gold, historically, and this might surprise you, have done very well in periods of debt-induced deflation, not productivity-based deflation. That's what we want. That's what growth companies are all about. Although our policymakers and many investors forget it, but we have collectively, as societies, moved away from productivity-based deflation. Deflation is a dirty word. Central banks looking for inflation instead, and they're doing that because we're hopelessly indebted, and all they're going to do is print more money. Well, at some point, enough investors are going to realize that those bonds aren't worth what they are based upon QE and artificially low interest rates, and neither are stocks worth what they are. And this is going to trigger the global bond vigilantes, a run for the exits. The central bank puts will no longer suffice. Economics will trump politics, and people will move into, at least at the margin, into assets that have shown that they can protect purchasing power and are a viable store of value throughout history. I'm referring to considering satellite allocations in physical silver and gold, the very assets, real money, that have been so punished in terms of their valuations by the central banks and those aligned with them to, in essence, keep the canary in the coal mine from shouting. And this very situation is what we address in our latest post number 13 in the blog section. We think it's a great time to buy what central bankers are pushing down and to consider selling what central bankers and their machinations through money printing and artificially low interest rates have pushed up. Referring to global bond and stock values, we're looking to the point where investors will once again demand real yields, they'll demand solvency risk compensation, and they'll demand insurance against monetary inflation risk coming home to roost. All these things suggest the values of stocks and bonds, together with our business cycle coming to an end, will come under substantial pressure, and people will look at the margin as a satellite allocation, not only to go to cash, which we strongly suggest, and treasury bills, not bank-based deposits or commercial paper, but treasury bills, and at the margin into physical silver and gold. Because these are the assets where we know they're going to hold their worth, and these are assets which aren't based on debt. They're based on sweat equity, on productivity. And they're portable, and they're fungible, and they are very scarce. And what happens to assets that are very scarce, we're talking now physical precious metals, investors tend to change quickly, shift allocations, and if the shift is into a scarcity asset, then you can increase supply very sharply, which means that precious metals, which are now artificially under pressure price-wise, could well find a substantially higher equilibrium price and thus fulfill their age-old function of protecting purchasing power, of being stores of value, of offsetting likely substantially lower bond and stock prices over time. That's what we talk about and quite a bit more in our most recent post on investing in debt-induced deflation. We hope you take a look, and we thank you for your interest. Bye-bye.